Human brains are good at pattern recognition and memory, so chart patterns are easy to spot in a historical chart. Once you have identified a pattern, you can visually backtest that pattern by noticing how price reacts after that pattern is completed and confirmed. There are dozens of recognized chart patterns that traders can employ to help signal potential trend reversals or price breakouts. In this video, we will focus on 3 popular chart patterns: price pivots, key reversals, and opening gaps, to help get you started with technical chart patterns. Price pivots are multi-bar patterns that can help detect turning points in the market. The pattern is identified based on the number of bars to the left and right of a significantly higher high or lower low, generally at the end of a significantly trending move higher or lower. Let's say we set up our pivot pattern parameters to look for a price pivot with 8 bars to the left and 3 bars to the right. Once we have 8 lower lows, followed by 3 higher highs, our pivot up pattern is complete. And once we have 8 higher highs and 3 lower lows, the pivot down pattern is complete. Pivots often occur at the end of the current trend, but can also appear in the middle of a trend as a pullback, and then the trend continues in the previous direction. Key reversals are 2-bar patterns that can help detect a short-term change in market trend direction. The patterns form after an observable downtrend or uptrend, generally used on daily charts to provide short-term swing trading opportunities that last a few days. We will look at the basic key reversal pattern here. A key reversal up pattern starts in a downtrend. Then the key reversal bar, current bar, makes a low that is lower than the previous bar. And then the close of the key reversal bar, current bar, is greater than the close of the previous bar. This can often create an outside engulfing bar. Orders are generally placed slightly above the high to help confirm the new direction. A key reversal down pattern starts in an uptrend. Then the key reversal bar, current bar, makes a high that is higher than the previous bar. And then the close of the key reversal bar, current bar, is lower than the close of the previous bar. Again, this can often create an outside engulfing bar. And here, orders are generally placed slightly below the low to help confirm the new direction. Very similar to pivot points, the stronger or longer the current trend, generally the higher the probability of the key reversal signal direction. In today's world of 24-hour Globex markets, a trader might think that the concept of opening price gaps may be an obsolete subject. Gaps generally occur when there is an order imbalance at the open of the session. A gap on a chart occurs when prices jump significantly up or down from the previous closing session. A gap pattern requires the low of the current bar to be above the high of the previous bar, gap up, or conversely, the high of the current bar to be below the low of the previous bar, gap down.